Wait, why are we clapping? You're syncing. What are you syncing?
I'm syncing your track and my track because
Right.
we're not recording in the same room.
Ah, okay.
So I need some sort of mechanism where I can sync them up. And that's the clap.
Yeah, okay. But so 1, 2, 3, and then clap, or 1, 2,
Exactly.
and then clap on 3.
No, 1, 2, 3, then clap.
This same thing came up in, what was that movie, Lethal Weapon, where, remember the toilet was going to blow up and they had to pull the guy off the toilet, and it was like, do we go on 3?
Do we do it on 3 or do it 1, 2, 3, then do it?
Well, it's your ass, Cochise. I mean, it's up to you.
There was a whole extended discussion. Anyhow, the stakes are not that high right now. So, but let's get it 1, 2, 3, and then we clap, and then we're starting,
Exactly.
right? All right, who's going to do the counting?
I'll count. 1, 2, 3.
How'd I do? All right.
That was good. That was good.
Okay.
Thank you.
Now all I need is something to say, right? We've got, I don't think there's much. We've got a conversation coming right up with Barron's own Andrew Bary. And he's going to give us his top stock picks for 2026. If you don't hear all the ticker symbols or any of the ticker symbols, don't worry, I'll give them all to you at the end. And that's it. Let's get to the conversation. Andrew Bary, as I live and breathe. I looked at my calendar today and it says Andrew Bary's top stocks. You can imagine my excitement. How are you?
Doing great. Glad to be with you, Jack, for another run at this.
Each year you put out your top 10 stock picks for Barrons, and you had quite a bit of success last year. Well, how'd you do?
Yeah, I mean, we had a great year in 2025. We had 10 picks, and they were up in total return about 28%, which was more than 10 percentage points better than the overall market. And we make the picks in December. We measure them 12 months later. We can't change anything. So we got to live with them. And I mean, this can be a humbling game. I mean, 2024 was not great. And so, I mean, we're hoping for a good 2026. And I think we have a good list here.
Hold on. I just want to make sure I've got the numbers right. 28% last year. That's including dividends. And the S&P 500 returned 15%. So you nearly doubled the S&P. So you're calling it a humbling game, but right now you're riding high. You're riding high in the saddle.
I mean, we're definitely riding high, and some of the stock picks we made are even off to a pretty good start for 2026, but it's a long game. It's a full year. I mean, let me tell you a little bit about what's behind the 10 stocks. I've got a more of a value orientation, so many of the stocks are quote-unquote value stocks. They're not some of the growth darlings in the market. So we have picked 3 growth stocks that have been laggards in the market during 2025, and I think if you pick quality growth companies that have lagged the market, that's often a pretty good investment strategy, but we can get into some of the names in a few minutes.
Am I right that the approach is not the same thing every year? Like you might change it depending on how the market's positioned or what's cheap or what have you. Like last year, you had a number of kinds of tech stocks that won big.
Yeah, I mean, I try to go where I think there's opportunity. And I mean, this past year, we won with a couple stocks. Google, which was the best stock in the Mag 7, Citigroup, which was the best bank among the major banks. Alibaba was a huge winner. Uber was a big winner. So, I mean, they were among the stocks that really powered the 10. None of those stocks are on the list for this coming year. I try to have a new group or have very little overlap. I try to have a fresh group. And I think some of the stocks have gotten to be more fully priced for 2025.
All right, let's put this hot hand to work for your picks for 2026. Is the list on the whole cheaper? Is it more of a value tilt this year than last year?
I would say it's more of a value tilt than last year. But I mean, there are also some special situations as well.
All right, let me run through these names. The first one I've heard of, it's Amazon.com.
Well, Amazon is actually the worst performer among the Mag 7 stocks this year. It's basically about flat. Stocks trading in the 220s right now. And there are like twin concerns. One of them is that there was a slowdown for part of the year in their Amazon Web Services, which is their leading cloud computing business. And I think there may be some lingering fears about the health of the consumer, and as well as whether they'll be as much of a beneficiary from the AI boom as some of the other Mag 7 companies. But it's left the company and the stock trading at a pretty reasonable valuation. It's trading for under 30 times 2026 earnings. We're using a conservative 2026 estimate that includes stock compensation. That's below Walmart, below Costco. And this is a double-digit earnings grower with two phenomenal franchises, e-commerce, where they're the leader in the United States, over 40% market share, and Amazon Web Services, the leader in cloud computing, plus some interesting other businesses, advertising, $75 billion in revenues, very high margin, and other things like Alexa and also a satellite communication business which may compete against Elon Musk's Starlink.
Have you used Rufus yet in your shopping? Amazon's Rufus
No,
AI?
I don't use any of that kind of stuff. I mean, I'm a single guy. I mean, and so I don't really need, I kind of know what I like. And
Well, I'm not asking you to start a relationship with Rufus. I'm just asking if you're using it for shopping.
nah.
All right.
Nah.
Next one, Bristol Myers Squibb.
I mean, the drug industry this during 2025 has been a story of haves and have-nots. The biggest have has been Eli Lilly, the leader in the GLP-1 diet drugs. Bristol Myers has been a have-not along with Pfizer and Merck. It's viewed as being a company with a somewhat challenged outlook in terms of the quality of its pipeline, and also it's facing some patent expirations on key drugs. Stock is flattish to down this year, but it's trading cheaply now, nearly a 5% dividend yield, the PE ratio.
I love that.
Yeah.
Gigantic dividend.
Very nice dividend, and I think it's very sustainable, and you've got a PE under 10, and you've got an underappreciated pipeline. They've got a drug for Alzheimer's, which I think could be an interesting one. The stock is actually starting to pick up a head of steam. This was actually recommended by Barron's Investor Circle, which is doing stock picking in conjunction with Barron's. And I try to be somewhat collegial and in terms of taking some ideas from some of my colleagues, but I think that they're good ones.
Okay. Now look, Comcast. I can think of a lot of reasons to not like Comcast, right? Trouble in television, trouble in even the cable broadband business. I feel like telecom has come after that hard with all the fiber that they're laying out. So what's the appeal here? Is it that it's cheap? Is it that I'm underestimating the strength of the broadband business? What do you like about Comcast?
Well, yeah, you're right about that. I mean, the stock has been a weak performer this year, down 15, 20%. It's now trading around 28 or 29. The concern is that there's more competition in broadband, which is by far their most important business, from telecom companies like AT&T that have laid fiber. Also, T-Mobile and others are offering what's called fixed wireless, which is a low-end version of broadband, which is less expensive. There's more competition. There's price competition. And that's been depressing Comcast stock. But it's a very cheap stock, nearly a 5% dividend, one of the lowest PE ratios in the S&P 500. It's only around 6 for 2026. And you could see a catalyst. They have a big media and entertainment business, NBC Universal. They own the theme park in Orlando, which they just opened a new one. They have NBC. They've got Universal Pictures. And there could be a spinoff of that business during 2026. And that could be a catalyst. It could.
A spinoff of which business?
Of the media and entertainment business, NBC Universal, which they call NBCU.
It looks like there's buyers out there for legacy media assets, so why not, right?
I mean, if Paramount loses the battle for Netflix, it's a potential combination with Paramount. And if Netflix loses the battle for Warner, it potentially could do something with Comcast. And you've seen in the last couple of days, Comcast stock has started to rally. There has been some speculation that an activist may surface in the stock. The company is controlled by the CEO, Brian Roberts. The Roberts family founded the company. His controlling stake is only about a 1% economic stake. And so there could be pressure on Comcast during 2026. And I think that could be bullish for investors.
Exxon Mobile. What's the chief appeal here? Is it tons of free cash flow? Is it opportunity to increase production? What do you like here?
Oil has been an outlier in the commodity markets. Oil's been weak this year. It's under $60 a barrel, down 15, 20%. In fact, oil recently hit its lowest levels in a couple of years. Exxon Mobile is the champ, the best company in the industry. It has the best balance sheet, best management, best production. I think argue the best outlook, best diversification. So it's a quality play in an out-of-favor sector. The stock has held up reasonably well given the fundamentals, but they're looking to boost their production in the coming years. They're very strong in the Permian Basin in Texas. They also are the leaders in one of the best oil fields in the world off the coast of Guyana. You're talking about a stock that's trading around 15 times forward earnings with about a 3% dividend yield. Super solid. It's a conservative play right now.
Have you watched that show Landman?
Yeah, I love that show, Landman.
I knew you would love that show. You're a Landman guy.
Yeah, I love the whole oil patch and the outsized characters and the craziness that goes on down there. It's interesting that, the Landman commented that, Exxon and Chevron don't really get involved in these kind of games because, they don't really need to play in the gamier side of oil and gas exploration. But anyhow, Exxon is definitely a quality company.
Okay, now let me see if my math is correct here. Amazon, Bristol Myers, Comcast, and Exxon. So we're going to do one more, and then we'll be halfway through, and then we'll take a break. So the last one before we take a break is Fairfax Financial Holdings. I'm not that familiar with this one.
Well, let me introduce you to it. I follow Berkshire Hathaway very closely. Berkshire's been on our list of top 10 stocks for many years. I took it off for 2026. I put on Fairfax, which I would consider to be a mini Berkshire Hathaway. There are a number of companies that have pursued a similar strategy to Berkshire on a much smaller scale. I think Fairfax is one of the better ones, based in Canada, founded by someone named Prem Watsa, Watsa. And it's got a great long-term record in terms of stock market performance and book value growth. And right now, it's trading mostly in Canada. You can buy, there's some U.S.-listed shares which are not super liquid. The ticker is FRFHF.
What's the specialty in terms of what they invest in?
So it's basically insurance and investments. It's property and casualty insurance and investments. They aim to grow their book value 15% a year. And if the stock price follows book value, which is done historically, you could be staring at a 15% plus return. They're also very shrewd investors, and they have some very successful investments outside the United States, particularly in India. They've invested in some Indian fintech companies. They also control the Bangalore airport, of all things. So it's an interesting mix of businesses. And actually, a former Berkshire Hathaway executive, David Sokol, who left Berkshire about 10 years ago, is actually involved in running a shipping business for them. It's a nice package and not well known, but I think it will become better known, particularly if they get a more high-profile U.S. listing.
We're speaking with Andrew Bary, Barron's associate editor, with his top 10 stock picks for 2026. The first 5 are done. We'll hear about the next 5 coming right up after this quick break. Welcome back. Andrew Bary from Barrons joins us with more of his top 10 stock picks for 2026. Andrew, I think half my town is sick with the flu right now. I can't remember you ever getting sick. Do you not ever get sick? What's your secret?
I try to be indestructible and an Iron Man. I'm not sure what. I think it's more luck than anything.
There's no herbal remedy.
I don't buy into any of those supplement stuff. I eat a Warren Buffett style diet, which is like cheeseburgers and Cokes and hash browns.
Don't make me laugh. I'm too congested. All right. We left off with Fairfax Financial Holdings, and we're still on the Fs. Next up is Flutter Entertainment. Tell us about Flutter for people who don't know the company.
Well, most people in the United States don't know Flutter, but they do know it's U.S. business. It's the leading online sports gambling company in the world, and it owns FanDuel, which is the leading online sports betting company in the United States. It's bigger than DraftKings.
Now, what I know about sports betting, obviously it's exploding, but I hear about everybody getting into these prediction markets, and there just seems to be a lot of competition for taking these bets between the prediction markets and the traditional sports gambling companies, and of course the casinos that were in that business to begin with. Where is this company positioned that you feel like it's a good pick?
FanDuel is the center of and the focus of the company. You're right that the growth in prediction markets, Kalshi, Poly markets, has hurt Flutter stock this year. It's down this year. But it's difficult for prediction markets to replicate what the online sports gambling companies can do. For instance, at Flutter, one of the most popular things and one of the most profitable parts of the business are so-called parlays. It's multiple events in a single bet. Like rather than betting the Knicks are going to win tonight, you would bet that, Brunson's going to score 40, and you might have Josh Hart scoring 30.
Wembayama's going to hit his head on the rim, whatever it is.
Right. And so you might have 4 or 5 events, and it's a big payoff. They're harder to structure. You need to have expertise. That's very popular. Also so-called prop bets, which are unrelated to the outcome of the game. How many points is Brunson going to score tonight? How many minutes will he have? What color will a Gatorade will be thrown on the coach at the Super Bowl after they win? That kind of stuff you really can't have in prediction markets, and I think they really excel at doing that. And the stock is trading now for about 20 times 2026 earnings. Given the fact that the earnings are growing 40% this year, and I mean during 2026 and 2027, I think it's a pretty reasonable valuation. And the company moved its primary listing to the U.S. in the last year or so. It could be added to the S&P 500 during 2026, which would be a nice bump.
By the way, speaking of the Knicks and Wemby, the Knicks beat Wembyama and the Spurs to win that mid-year championship they're doing in the NBA. I forget what they call it, Emirates or something like this. So the Knicks are looking good. And your next pick here is Madison Square Garden Sports. What do you like there?
Well, Madison Square Garden Sports owns the Knicks and the New York Rangers, and the Knicks are having a great season so far. I mean, whether or not they can get past Oklahoma City, which is the best team in the NBA, one of the best teams ever.
My sources are telling me they cannot.
Yeah, I know. So, I mean, that's going to be an impediment come next spring during the playoffs, I think, for them. But the story with MSG Sports is it's a very cheap sports play. Sports investing is really hot. There are a lot of private investing going on in sports companies. And the market value right now of Madison Square Garden Sports is about $5.5 billion. The value of the Knicks alone is probably $10 billion. The Lakers in Los Angeles sold for about a $10 billion valuation in the past year. The Rangers are probably worth $3 to $4 billion. That's about 13 to 14 billion. So at $5 billion, you're paying a very big discount to the value of the two teams. Why does it trade so cheaply? They call it the so-called Dolan discount. The Dolan family controls the company. Jim Dolan is a CEO. He's essentially ruled out a sale of the company, and that's why it trades so cheaply. I mean, that's not great corporate governance. You could see potential activist involvement in this stock, and there's a possibility they might split the two teams, create a New York Knicks stock, a New York Rangers stock. They also might sell partial interest in one of the teams to some rich people and use that money to buy back stock. I think there's a lot of quote unquote optionality or ways where you could win with MSG Sports in 2026. It's a far better investment, I think, than buying a lot of these private sports investing things that are now very popular with rich people.
I feel like with sports teams and ownership, there's a lot of vanity involved, which takes you outside of traditional economics, which means if in the future you want to sell something, I feel like there's a good chance that you can sell it for more than it's worth because of the vanity factor.
Yeah, the vanity factor is big. I mean, if the Knicks were to go on the market, there'd be like tremendous interest. If the Rangers went on the market, there'd be tremendous interest. The problem with sports teams, they tend to not make a lot of money because of high player salaries and other issues. Like MSG Sports has no dividend. It's got very little free cash flow. I mean, the payoff really comes in a sale. And one of the reasons why the stock trades so cheaply is that no one sees a sale as being imminent or if ever. And there's not a lot of income or cash flow being generated in the interim. So that's why I think there's the opportunity right now.
Here's a name I see around town, and by town I mean New York City, SL Green Realty.
SL Green Realty is the leading commercial property owner in Manhattan. They own a lot of office buildings, particularly in the so-called Grand Central corridor around Grand Central Station. They own One Vanderbilt, which is a huge 1,000-plus foot tower, which is very valuable. It has an observatory at the top. And it's out of favor for a couple of reasons. There's some concern about the incoming mayor, Mamdani, who is a Democratic socialist. He's not exactly a business-friendly guy, and he's talked about freezing rents, but he was talking about freezing rents on apartments, not on commercial. So I think there's a bit of an overhang from the Mamdani factor. The stock trades cheaply. It's in the mid-40s right now. Its dividend yield is north of 5%. And the company recently had an investor day where they think that the net asset value of the company is well north of $70 a share. The stock's trading in the mid-40s right now. So I think it's an interesting play in what's now an out-of-favor sector, which is New York commercial real estate.
Okay, the next pick on the list is Visa. What do you like about Visa?
Visa is one of the great financial companies. It and MasterCard are the leader in terms of payments processing for credit and debit cards. Went public more than 15 years ago. Huge winner. It's a so-called compounder. It grows its earnings, which means it steadily grows its earnings pretty much regardless of the economic environment. It's a very durable business model. Stock has come under some pressure this year. It's been a bit of a laggard. The reasons include concern about threats to their kind of near monopoly position with MasterCard stablecoins, buy now, pay later. And merchants don't like them, but everybody else pretty much in the payments ecosystem does like a Visa. Very high margins. The world in America continues to move to plastic from cash. It's a big headwind, plus economic growth and greater spending. And it's really almost a toll taker on some of those trends. The stock is not cheap. It's trading for about between 25 and 30 times earnings. But given the low double-digit to teens growth rate on the company, I think it's pretty reasonable and it's very high quality.
I'm starting to feel a little bit sad because we're through talking with 9 of these stocks. There's only one left.
Well, the last one is near and dear to you, Jack. It's Disney. You wrote a cover story on it for Barrons during 2025.
It's not nearly as near and dear as it was when the kids were small. I used to go to some of their parks. This is before now it's like billionaire pricing over there. But, and also the kids are older. But
well, I mean, that's one of the issues. Disney stock is about flattish this year. And one of the concerns is that they've raised prices so much, particularly at Disney World, which is the key part of their parks business, which in turn is probably the most valuable part of the company. People are concerned that, I think, you may know better than I do. I think you can pay $200 a day per person at Disney World during the Christmas season. It's a very expensive trip.
I spend that much on churros. Go ahead.
But Disney stock is trading now around 110. It's trading pretty reasonably now, especially in light of the takeover battle for Warner Brothers. I think Disney trades cheaply relative to Warner, cheaply relative to some other media plays. It's trading for about 16 or 17 times 2026 earnings. They've projected 10-ish% growth in earnings in 26, 10% in 2027. So you get a nice earnings trajectory. And there could be some catalysts ahead depending on what happens with the Warner Brothers takeover battle. Plus, you have a wild card. Bob Iger is finishing up his second run as CEO in 2026. He's due to retire at the end of the year. I think he wants to go out on a high note. So far, his second tenure has not been super great from a stockholder standpoint. We don't know who the next leader is going to be in Disney, but I think that could be an interesting potential catalyst for Disney during 2026. It's a low expectation stock now, and I think it's worth people taking a hard look at.
What levers does Bob Iger have at his disposal to pull if he wants to get the stock working better in 2026? If he's leaving at the end of the year, that's not much time to get some buzz going around the stock.
Well, that's unclear. They got the streaming businesses, you got the parks business, you got ESPN, you got the ABC. You've got a lot of pieces there. I don't really have an RX for him in terms of what they could do. It's not like Comcast where there's an obvious thing they could do, which is spin off their entertainment business. Disney's already entrenched. They feel that the ecosystem that they have right now is very valuable and works, and they don't need to, quote, do anything. And, right now, Disney and Netflix have about the same amount of earnings of net income, and Netflix has twice the market cap. I just don't think that's justified. I think Netflix is a great company, but I don't think it's twice as good as Disney is. And as Netflix is showing now, then when they're in bidding for Warner Brothers, they seem to want to add to their empire when a lot of people thought they had all they needed. So I think Disney versus Netflix could be an interesting trade for 2026. It's already happening because Netflix has been underperforming recently.
Thank you, Andrew. I promised everyone some ticker symbols. Here they are. Amazon, AMZN. Bristol Myers Squibb, BMY. Comcast, CMCSA. Fancy 5 letters. Exxon, XOM. Fairfax, the ticker is FRFHF. To remember it, just say FRFHF. Flutter Entertainment, FLUT. Madison Square Garden Sports, MSGS. SL Green Realty, SLG. Visa, look at you with a 1-letter ticker, V. And Disney is DIS. Thank you all for listening. Alexis Moore is our producer. You can subscribe to the podcast on Apple Podcasts, Spotify, wherever you listen. If you listen on Apple, you can write us a review. If you have a question you'd like played and answered on the podcast, you can send it in. It could be in a future episode. Just use the voice memo app and send it to jack.how, that's HOUGH, @barrons.com. See you next week.